afternoon, ladies and gentlemen. First of all, thank you for joining. My name is Thushar Thakker. I am from Peraj Insurance Brokers in Mumbai, India. Privileged partner of Greco for many years, and I'm happy to share a presentation on the current scenario of the insurance market in India. To begin with, I will just take a minute or two to tell you a few things about our company, our organization, what we do, and later on we will go through the current scenario of the market in India. So first, the background of my company. It's a family-owned company established in 1952 by my grandfather. I'm the third generation to join this business from the family. In the initial years, the market structure in India was very different from what it is now, and we were working as principal agents for three reputed British companies. Historically, we have always focused on client-dedicated services, so we have not ventured into businesses like reinsurance or loss adjusters, where we have any obligation towards insurers to generate business. This was mainly to avoid any conflict of interest for our direct clients, that is the policy holder. Provide services across the length and breadth of India, so I have actually customers at all four corners of India, the farthest corners of India. But we are also providing services for many years in Nepal and in Bangladesh. Of course, in Nepal and Bangladesh, the broking system does not exist, and we provide services on consultancy basis. We have good equation with the markets there, with the insurers in Bangladesh and also in Nepal. Our international business, we have been active for over 40 years. We started our international business way back in 1978. With Hogg Robinson of UK and Johnson and Higgins. Subsequently, we joined the original Unison network, which was the first ever network of independent brokers in the world. Currently, we are working with many US, European brokers, almost 400 of them, including some captive brokers of large corporations. We are also a recommended broker of many large US and European insurers like Chubb, Zurich, Allianz, AIG, Berkeley, CNA, and a few others, I think Travelers and some others also. And we are also recognized by risk managers of many US and European large corporations. So there are many instances that we work across networks. For example, if the client is elected Marsh or Aon or Willis as a global broker in India at the instance of the risk manager, we are working for the Indian subsidiary. So our philosophy has always been revolving around building long-term relationships, be it with our clients, and we have clients with us for 3 or 4 decades, clients who have worked with all generations of my family. So we believe in building long-term relationship with clients, with our partners. Greco is a classic example also, and also internally within the organization. So team members have been with us for decades. Claim servicing has always been one of our core strengths. Many large relationships that we have started on the basis of a successful handling of claims in the sense that there were claims which were referred to us where we were not the broker on record, but repudiated claims were referred to us, or complicated claims were referred to us, and on basis of a successful settlement we have started relationships with these clients, and they have lasted over a long period of time. So insurance companies in India, there are separate licenses issued for life and non-life business. In the non-life business, and this presentation is mainly revolving around the non-life market, there are 7 state-owned and 28 private sector insurance companies operating currently. I'm sorry, there's one mistake here. International brokers and loss adjusters are allowed maximum of 100% holding now. Until recently it was capped at 49%. Insurance companies can own up to 74%. So when the private insurers, international insurers were invited in India for the first time in 2001, they were allowed maximum of 26% equity in the joint venture. It was then increased to 49%, and last year it has been increased to 74%. Brokers can now own 100%, so you can have a fully owned subsidiary in India. It's a tightly regulated market. Every insurer needs to report solvency margins to the regulator on a quarterly basis, and if the solvency margin dips below the required standard, then the the regulator would step in and ask the insurer to infuse more funds immediately. Licenses are issued for 3 years and renewed every 3 years. So as I said, that the insurance companies can now hold 74% in their joint ventures. So companies like Generali and some others have increased their shareholdings recently. So these are the list of insurance companies in India I have listed, which are 100% local and which are joint ventures. So you have among the international players, you have Allianz, you have Sumitomo, you have Generali, you have Ergo, Generali is repeated twice. Then ICICI Lombard, it was earlier joint venture with Lombard of Canada, but that has moved out now. Most of the equity has been diluted. It is also the largest private insurer in the country. We have Tokio Marine, we have Liberty, then there is Magma, HDI. Incidentally, our client too, we are the brokers for Magma HDI, so we do their entire book of all lines of insurance. We have National Insurance Company, which is state-owned. We have Raheja QB Australia. Reliance General is a 100% local company, but it is the promoters are exiting the business, so it's up for sale. And Zurich has attempted to acquire this company. So basically, Chubb and Zurich were the major international players who are not present in India. Chubb was, but they exited the business because they were not allowed the full 51%. Now that the government has relaxed this, both Chubb and Zurich are trying to enter the market. Royal Sundaram was earlier Royal and Sun Alliance, but now it is 100% local. IAG of Australia is in joint venture with SBI, which is India's largest bank. We have Sanlam from South Africa, but primarily into commercial trucks insurance. We have AIG with Tatas, of course everybody knows. The New India Assurance Company is India's largest insurer. It is owned by the government. This company was originally formed by Tatas before the banking and insurance sectors were nationalized. Oriental is state-owned, United is again state-owned, then you have Sompo of Japan. And then there are some insurers who are mainly into health, only health insurance, retail and group. And then you have the Agriculture Insurance Company of India and Export Credit Guarantee. Although the name says Export Credit Guarantee, since few years they have been writing even domestic sales. And in the health insurance space, you see Apollo, Cigna and Bupa also. So these are all well-known names. This is of interest to you for sure. These are the fronting company affiliations. Zurich has 3 affiliations in India: Bajaj Allianz, ICICI Lombard and HDFC Ergo. The reason I say this is important is that sometimes your client might want to have a choice, and normally the insurer will not inform, master insurer will not inform you that you actually have options. They will randomly choose the partner for a particular client, but in some cases you can make choice, although it's not an open choice is not very open and wide, but at least from few you can. AXA XL has 2 affiliations. AXA XL was also present in India by a joint venture, but about 2 years ago they sold the operations to ICICI Lombard. If PNC has two, ICICI Lombard and HDFC Ergo. Travelers has HDFC Ergo. FM Global has two, ICICI Lombard and HDFC Ergo. HDFC Ergo was previously HDFC Chubb. Chubb has an exclusive arrangement with ICICI Lombard, so do Swiss Re, Hartford and Globex. Allianz has a joint venture in India, Bajaj Allianz, and AIG has a joint venture in India. So most of the insurers are well spread across the country. They have offices in all major cities, but the state-owned companies have a lot more penetration. They have offices in smaller towns and cities also. Most of the business is written from standard policies such as motor. Motor contributes to a very significant portion of non-life business in India. Then you have, of course, the PD, not BI. BI is still not a very developed concept in India, and I explain that in the slides coming up. Then you have the CAR, ER, marine and employee benefits. Until recently, all the insurers were obliged to have at least a 20% cession to GIC, but currently it is reduced to 5%. For treaties, they largely depend on GIC, Munich Re and Swiss Re. Munich Re and Swiss Re have very deep roots in India. They have been doing business for decades now, an extremely strong relationship with the local markets. So we have currently a mix of tariff and non-tariff policies. We still in India follow a concept of named peril policy for property damage. Although the form is available for an industrial all risk policy, there are few takers. Again, I'll explain that in the coming slides. So you have a fire and allied peril policy for property damage. Then there is a separate policy for business interruption on account of these perils. Then separate policy for burglary and housebreaking. You have the option of industrial all risk policy. Then you have the CAR, ER policies. Then you have an all risk policy for electronic equipments, where you can make a choice. You need not cover the entire set of equipments. Machinery breakdown. BI on account of machinery breakdown. LOP is, we use the term loss of profit for business interruption. Motor and workers' compensation. We have terrorism cover on a flat rate basis, which is operated as a pool by the GIC. Similarly, motor third-party covers are also operated as a pool by GIC. Marine medical and accident policies have been non-tariff for some time. Currently, the PDBI and marine are governed by tariff. When I say tariff, it is both rates and the wordings are governed by the tariff. Deductible wordings, etc. They are common for all insurers. The latest development is that the regulator is pushing the insurers and GIC to de-tariff the rates for PDBI from the 1st of April. The time frame is too short to implement this change, and the market is not ready with the infrastructure, so there is a lot of resistance from the insurers and the GIC. There is a crucial meeting which will take place in India. We are putting all insurers and the regulator on one table. This will be on the 1st and 2nd of March, and we will have the final outcome. But what it looks like is that there will be some reduction in the rates for certain risks which are better protected. For ER, CER, rates of AOG perils are prescribed, but for other perils, insurer can freely rate. Employee benefit liability are out of purview of tariff. There is a strong possibility following a couple of bad incidences in recent past that AOG perils will become more expensive from the 1st of April. When we say AOG peril, they are mainly STFI, that is storm, tempest, flood, inundation, which has common rates across the country. And then there's earthquake, but earthquake rates are defined as per earthquake zone in India. So Normally, the standard cover is named peril policy for property damage, and then you have engineering insurances for construction projects, marine, etc. These contribute to majority of the portion of premiums collected other than motor and health. IAR form is available, which incidentally Peraj had helped the authorities to design way back in 1984 or 85. But as I was mentioning that in India, the concept of buying BI cover is very, very limited. And also for machinery breakdown, there are few buyers. But when you buy an IAR policy form, you have to buy machinery breakdown for the entire set of plant machinery, and you have to buy business interruption. You can opt to not buy business interruption on account of machinery breakdown though. But for other perils, it is mandatory. There are 3 compulsory covers in India. There is third party cover for motor vehicle. Again, this has 2 parts, third party property damage and third party bodily injury. Third party bodily injury must be covered by each vehicle for unlimited amount. But the good part is that this cover is available for as low as about 30 euros. I mean, something between 20 to 30 euros depending on what vehicle you are using. And then there are certain hazardous chemicals, and there is a threshold limit defined. So if you are storing above this or manufacturing above this limits, then you must buy a Public Liability Act policy. Demand is growing for clinical trials. You know that pharma is a big industry in India. It's one of the largest manufacturers, and it is growing. Clinical trials, product recall, most of them are not buying because they are quite clinical trials people have to buy, it's compulsory. Product recall, most of them don't buy, and it's quite expensive to cover, particularly if there is a USA Canada exposure. So if you just go through the major lines of business, the standard PD policy, as is called the standard fire and special peril policy. The peril covers are fire, lightning, explosion, implosion, aircraft damage, STFI, that is act of God peril, impact damage due to railroad vehicle, subsidence and landslide including rock slide, bursting and overflowing of water tanks, apparatus and pipes, missile testing operations, leakage from automatic sprinklers, bushfire, earthquake and terrorism. So you can see that majority of the perils are anyway covered in this format of PD also. IAR cover is always covered subject to specific exclusions, although you can opt to exclude business interruption on account of machinery breakdown. Basis of indemnity under both the policies will be new for old, provided you have adequate sum insured, of course. And condition of average will apply. Under IAR, there is a waiver, automatic waiver of 15%, and in fire policy it can be negotiated up to 15%. So workers' compensation policy is structured a little differently than what you have elsewhere in the world. Here we do not have sum insured defined on the policy, so you have to just declare the total number of workers and the estimated wages during the policy period. The provision, of course, is that the immediate employer is liable for paying the compensation. So if there is a contract labor, it is the vendor providing the contract labor who is primarily responsible for the paying the compensation. But if that vendor fails to fulfill his obligation, then the liability will eventually come, financial liability will eventually come on the principal employer. So we must always advise our clients to cover all the workers, including contract labor. I'm sorry, the Act applies not just on the labor, but even all other employees. So all employees are falling under category of WC. Marine, a very broad form is available. So you have normal Institute Cargo Clause A for covering international journeys. Similar wordings are available for domestic transits, pure inland transits as you call, which is called the ITCA clause, and we must always remember to ask the insurer to put ITCA, ICCA wordings for all transits, including tail end risks. So imports and exports can be on CIF basis or FOB basis or CNF basis, but local transits have to be insured locally. I mean, local transits which are pure domestic transits. If it's the last leg of the export or the first last leg of import but first leg of export, it can be part of the cover taken by supplier or buyer. We still do not have the concept of stock throughput policy. It is still on sales turnover, and I'll take a minute to elaborate a bit on this because this is important. If particularly you have separate insurers for PDBI and marine. So to give you an example, if you have marine policy with A and PDBI with B, in India what is going to happen is that your the local fronting company will not issue a single policy for on a stock throughput basis. They will issue two separate policies. One would be for marine, and then there would be a separate fire policy for stocks. That policy will not be on an IAR basis, it will be on a named peril concept. Now the problem is that you have stocks covered also under the factory in that policy. So necessarily the single risk has two separate insurers plus two separate policy wordings. So we have to take care of this if we have the situation of having separate underwriters for PDBI and marine, that ideally we should get the stocks covered under the PDBI policy and not in marine. And plus always the issue would be that how would the BI trigger if the loss only is for stocks, on stocks. Again, for CER, a very broad policy form, it's a Munich Re form, is available. Project duration over 12 months, premium can be paid in installments also. If terrorism is covered and if terrorism premium is paid in advance, there can be discount for upfront payment of the premium. Very few policies are issued for delayed startup or advance loss of profit. So local capacities are also small. It needs facultative reinsurance support if somebody wants to buy a large limit. Machinery breakdown, if it is not part of the IAR cover, so machinery breakdown or construction contractors plant machinery or electronic equipment, these policies can be taken on selective basis if the client has opted for a named peril concept. But the basis of indemnity under each of these policies is on depreciated value. So liability is a slowly developing concept in India. If you look at the total premium on casualty and financial lines, this is approximately 4% of the overall premium in India. Sorry. By the way, liability insurance was introduced in India for the first time by Peraj in 1978. So all the covers that you normally would buy, CGL, ENO, DNO, EPL, are easily available. Local capacities without going to the fact market could be up to $100 million if you talk to insurers like ICICI Lombard or Tata AIG or HDFC or Go. Product recall cover is available, smaller limits though, if you don't go to the fact market, but it's quite expensive still, and more particularly for auto component and pharma companies. I think this is the same everywhere. Clinical trial is steadily growing business in India, but for larger limits you need a reinsurance on facultative basis. Exposure to USA, Canada is more expensive than other markets. Again, I think this is a global. The last point is very important. Very few policies, particularly I'm talking about CGL, are issued on occurrence wordings. Most policies are on a claims made basis. So you need to ask, if your program policies are on occurrence based, you will need to ask the master insurer to make a specific request to the local insurer while taking the court to get occurrence wordings. Also, most of the insurers in India issue policies on right to defend basis. Only AIG, HDFC and QB have their basic form is on duty to defend basis. ICICI Lombard uses right to defend basis on most cases, can issue on duty to defend basis upon asking. So it's important to ask. You already have the names of the fronting affiliates, so you know whom to direct to. So the leaders in liability lines are ICICI Lombard, Tata AIG, Ergo, and to some extent QB provides good wordings and competitive rates. As I said, indemnity limits up to $100 million would not be a problem per occurrence basis. Anything above that, GIC also provides sizable limits. Just for information, that GIC is open now to take inward RI from all over the world. They have been taking inward reinsurance from the nearby regions, like it's a major reinsurer for Bangladesh markets, for Indonesia, for Nepal, but now it is opening up to European and US territories also. Reinsurance ceding is permitted in liability. You know this because all of you are issuing local policies for 1 million and taking back most of it. So there are some obligation documents required for issuance of the policy. In some cases, in certain insurers have agreed to waive that requirement with their master insurers. For DNO, apart from a completed application form, insured also has to submit the latest audited financials. This is a legal requirement by the regulator. These are some things that you will need to know on a blanket basis for all the policies in India. Cash before cover law. So cover can commence only upon payment of premium. All the lines of business, all policies, including life for that matter, have a GST of 18%. Regulations are not like China, they are common across the country and to all insurers. Insurers cannot write risks outside the country, but inward RI they can take. But of late, some insurers have started accepting writing risks for Indian interest abroad. So subsidiaries of Indian multinationals, they can write few lines like liability and marine. Cover cannot be backdated, but in case of liability, you can have a retroactive date prior to the inception date. Non-admitted covers are strictly prohibited. This is a real grey area, and I am still seeing exceptions being made here. So most clients try and be very compliant on all lines, but I still have a lot of clients in India who do not have a local DNO and a local cyber policy, and they rely on the master program, and becomes all the more difficult and problematic for DNO, where reimbursement has to be made to a person and not the organization. You all know about the Adidas case, but in case of DNO it could become still more complicated. Again, the laws and legislations are common across all 28 states and 8 union territories. So basically these are the actual sections of different laws which prohibit. You don't need to read them out, but you can go through them and share with the client, their legal team or compliance team, if and when this discussion comes up. So, but just to explain in short, that the restriction is both under the Insurance Act as well as the Foreign Exchange Management Act, which is governed by the Reserve Bank of India, the Federal Bank of India. This law is more stringent than the Insurance Act. So the Reserve Bank prohibits any inflow and outflow of money, in the sense that the local client is not allowed to pay premium outside, unless of course a prior specific approval has been taken by the bank, from the bank, and nor allowed to receive the claims, proceeds of a claim. The proceeds of a claim into India without a prior approval can lead to a lot of complications. So broking system in India, this was not present in India up to 2002. The regulator pushes for the brokers to be knowledgeable, so it is mandatory to have at least 2 executives per branch as IRDA accredited insurance program. Appointment of sub-brokers is not permitted, sharing of commissions is not permitted. Again, for us also, licenses have to be renewed every 3 years. We also have to provide our financials every quarter to the regulator. There are typically 3 categories of licenses. One is a direct broker license, which is ours. Then there is reinsurance license, and then there is composite license, which is a combination of both. There are 662 brokers, direct brokers in India, but if you actually have to see in corporate business, you won't find more than maybe 15. Of course, I am hoping that you all will work with only one broker in India. Among the international brokers, you have Marsh, Aon, Willis, Houghton, UIB and Gallagher. In 2009, the license of Willis was cancelled by the regulator for non-compliance of law. They got a fresh license 6 years later. Aon discontinued their joint venture in 2017, after which they were under a non-compete clause for 2 years. During this period, they used an affiliate broker who had zero insurance knowledge and zero insurance background. When the non-compete clause ended, fortunately the timing was good for them. The government had already lifted the restriction of the ownership percentage, so they acquired the affiliate broker. In 2019, Gallagher took a small stake in a broker called Edelweiss, who also has an insurance company you would have seen in the list. In 2021, they completed full acquisition immediately after the government announced the relaxation. If you look at the promoters of the Indian joint ventures, most of them do not have any insurance background prior to getting into this business. So, you know, the earlier partner of Willis or earlier partner of Marsh, they were all not knowing anything about insurance except the spelling, maybe. The brokers are not allowed to issue policies. They are not allowed to handle premium, neither client money nor insurer money. So the premiums are directly paid to the insurance companies and claims are directly paid by insurers to the client. The percentage of brokerage is defined by the regulator for each line, and insurers are expected to follow the same. The market, as I said, it's very new. It's just 20 years old industry. So the total quantum of premium that is placed through brokers is about 35%. The rest all is still direct. So thank you very much for your time, for your patience. And if you have any questions, I'm very happy to answer.
Hi Thushar, this
Hello.
is Afrem.
Hello.
I have one question
Please.
for you. First of all, thank you for your presentation.
You're very welcome. It's a pleasure.
In the case fronting insurers, in case, for example, Zurich have 2 or more options to choose a fronting insurer, how about your experiences with these fronting insurers? Do you have any preferred partner?
No, you know, all of them have good experience in writing incoming international business. Some are relatively faster than others, some have some issue or the other. So I would not have a general opinion on this. I would go client by client, in the sense that it will depend where the client is located and which of the affiliate has a stronger office around that client. That is one. Second is, what is the client's portfolio, and for clients' other line of business, which insurer does he prefer or which insurer is likely to be the best option for them. So I think those are the criterias that would play for me if when it comes to making a choice in one of the two or one of the three local insurers. So for example, we have one French client as of now. It's through one of our strongest and oldest partners in France, DOCRC. This client is with us locally since about 17 years. Now we are discussing of moving the PDBI program PDBI into the program. But the client has a very complicated marine insurance structure in India because alcohol beverages in India is very regulated and the taxation system is very, very complicated. So you need a very strong insurer to support that because there are certain contingent liabilities which have to be kept open in the books for a very long time, and insurer has to agree to keep open those provisions. So, I would go to when the insurer, master insurer is Zurich. So if I have to go to the market, I would first talk to these two insurers or three insurers and say, look, we'll place this PDBI through you in the program, but this is my requirement for marine. And then whoever is able to offer the best solution, whoever is able to support on that requirement, I would go to him.
Okay, thank you, understood. My last question is about the brokerage. Well, most of our common clients are based on fee agreements, but in some cases we have smaller clients with brokerage agreements. I've learned there is a limitation in your country about the percentage of the brokerage. Is this correct?
This is correct, and it's a good question. Actually, I should have incorporated something around this on my presentation. As I've said in the slide, that the brokerage in India is defined by the regulator for each line. But a very important thing for us to know is that so far as the PDBI rates are concerned, or even the marine rates are concerned, the minimum rates prescribed by the national reinsurer are inclusive of the brokerage, the defined brokerage. For example, in PDBI, the basic brokerage is 11.5%, and the insurer can choose to give an additional incentive of up to 30% of that. So 30% of 11.5, so it comes to about 14.95%. The PDBI rate is including this 14.95%. So whether the client goes direct to the insurance company or through the broker, the brokerage remains the premium remains the same, the rate remains the same. So the point is that even if it is a fee-based account, if there is and the tariff rates are going to apply, then it's better to collect brokerage rather than fee. Because if you're going direct and not collecting brokerage on those accounts, it's just the insurer who's pocketing more margins for not doing anything extra. Any other questions?
Yeah, I've got a question. Hi, this is Rafael Buchner. I can remember from former Indian policies, when we tried to get local policies from a local client, that in India there is a kind of weird, strange numeral system that we are not acquainted with. I mean, this has nothing to do now, and special with the insurance issue, but do you have maybe for us some information, not now, but maybe later on in a PDF or whatever, because I could not find that on the internet, how you use the numeral system? Because like 400,000 would be something like 4 lakh, as I remember, or 4 comma 00 comma 000 and things like that. And we sometimes find that on insurance policies, but cannot define what the premium or sums insured or whatever is that really.
Right. So first of all, the insurance policy will provide both the premium in figures and in letters. So you have figures. Now figures, one thing is very simple. One is that where normally you use a comma that is to after euro to go to cents, you use a comma, we use a full stop there, and we use comma between the figures. So if you have 300,000, normally in India it's written 3, comma, 00, comma, 000. This is how
Yes.
normally it is written in India, but when you get a policy digest from us, Paraj, we know the system is different from you, so we write it the way you write, so it's 300, comma, 000.
So in case we should receive, I don't know, if there is if a client of us has let's say an acquisition in India and we get policy copies, we can feel free to send them to you to let us know what is the premium, the sums insured,
Absolutely.
etc. Because I had that in the past a few times.
Absolutely, absolutely. No, feel free to do that. We will not only explain those to you, but we could also make a comprehensive report on that and prepare a small policy digest for you, which explains not just the premiums, but also the coverages and the gaps in the cover.
Okay, perfect. Thanks so much. Thank you.
You're welcome. Greco is a friend and we do everything for friends.
Great to hear. Thank you.
That's
So,
it, I think, yes.
Thank you everyone for your time. Thank you for attending. I hope it was useful to you, and if you still have some questions later on, you all have the presentation. If you have any questions, details, please feel free to reach out to me anytime by phone, by email. I'm very happy to answer any questions that you may have or any support that you need. Decoding the complex numerology system in India also included. But anything, so please feel free and have a good day. Thank you very much.